Good morning, everybody. Hey, it's John King, and it is Friday, the 30th of May. Can't believe we are almost halfway through the year. Time is flying. Kids are getting out of school. Summer is summering, and I'm super excited to be here, and thank you for joining me. So let's kick it off with this week's market update. First and foremost, the biggest news this week was Trump versus Powell. So they met in the White House yesterday. First time since 2019. Trump was very, very direct, telling Powell, I want lower interest rates. I want you to lower interest rates. We need lower interest rates. You're harming the United States by making us not competitive with China and other countries that have lower interest rates. The problem is that's not the Fed's concern. The Fed only has two concerns, and that is inflation and jobs. And that's the only thing the Fed is legally allowed to care about. And so the fight between inflation and jobs really is coming down to a battle that may end up losing on both sides. And that is something called stagflation. Stagflation is a real concern. And so if we get back to what's going on with inflation and jobs, you've got inflation that is coming down, but the issue with tariffs is giving a lot of pressure for inflation to go up. The market itself is seeing some relaxation or pullback in inflation. That is good news. That should lead to lower mortgage rates, but it's not. We saw a little bit of a drop in mortgage rates from last week. The truth is we're still pushing high 6s to 7%. The good news is we have stability, but it is not moving down. And the truth is I don't expect that Trump is actually going to succeed in pushing Powell to lower interest rates. Now, back in 2019, there was a big argument that said Powell caved and is now set a precedent to cave to Trump because Trump pushed him to lower interest rates. He said no, and then within 6 months, he started significantly lowering interest rates. So now Powell is stuck in a hard spot because Powell basically is, if he starts lowering interest rates, even if it's for appropriate market reasons, then Trump can claim that he lowered rates because Trump told him to. And now Powell has an incentive because he doesn't want to, for the second time in a row, lower rates when Trump says rates are too high, you need to lower them. So it's kind of one of those positions where, you tell somebody, hey, you have to do something, and they adamantly won't do it because you told them to. They literally don't want to be. You let it be their idea, they would have been more willing to do it. And so I understand Trump's thought process here, but it may just backfire because by pushing Powell to lower rates and being this direct about it, after having done the same thing in 2019, and he won in 2019, rates ended up going lower. Powell's now stuck between a rock and a hard place because even if he thinks he should lower interest rates, if he does, it means Trump can say, here we go. All right. So what does this mean to you? Well, it means there's more buying opportunities opening up if you're open to looking for them. The challenge is a lot of people are saying, hey, John, I see houses coming off the market immediately. Yeah, good houses priced well are coming off of the market immediately. You've got to look past that. You've got to look one or two layers deeper on houses that are coming back on the market. One of my favorite strategies to get a deal on a home is a house that came back on the market. And there's a lot of them coming back on the market because when a house comes back on the market, the seller has already moved out. They've already spent the money. They've already decided, great, I'm past the listing part. I'm past the showing part. Now I'm in the closing part. And now they're back to having to have open houses again. They're back to having people walking through their home again. And so the best opportunity to strike is actually literally the moment the house goes back on the market because the seller just doesn't want to have to deal with all of that stuff. So watch for houses that came back on the market because that's a great opportunity for you to strike. Also look for houses that have been on the market for 2 or 3 weeks without a price reduction. The moment there is a price reduction, the seller's convinced that price is all they needed and they're going to find a buyer and they're not going to be willing to negotiate. But before the price reduction, they're very willing to negotiate because they're worried they're not going to get their house sold. And by the way, an insider secret, if you can offer them full price and ask for a credit towards closing costs, ask them to pay for a bunch of stuff, because then the seller gets what they wanted. The seller gets full price on the home. And that's critical for psychology, for thinking about what the seller wants. And that's what it takes to succeed in this market, because sellers are getting nervous. We've got a lot more sellers out there right now compared to what we saw a year ago, and a lot fewer buyers. And the buyers are being pickier because the ones that have waited this long have been waiting for interest rates to drop. Finally, they're like, okay, fine, I'll jump into the market, but they're being real picky. So you have an opportunity as a buyer to pick up some great deals right now. And again, using seller credits to your advantage, because it keeps the seller whole. They get their full price. They don't get their full price because they're crediting you money, but they get to tell their friends they got full price. So that's really, really important. The last big topic I want to talk about today is actually current homeowners, especially those who bought in the last 2 years. They're kind of being left out in the cold right now. The truth is, a lot of people in the mortgage industry talk, and even real estate industry talked about marry the house, date the rate. Hey, inflation is transitory. The Fed said inflation is transitory. These rates shot up. Get into a house with a temporary buy down, they said. Get a low payment and rates are going to drop in the next year or so, they said. Well, none of that came true. And now we've got issues in the market right now. We've got buyers who are struggling to, or homeowners who are struggling to afford their monthly payments. And I don't expect this to be a major issue with the market, but I do think there's some houses that are coming on the market for buyers that bought a couple of years ago that expected their mortgage to be more affordable today, and they just can't afford the home. We, as an industry, set some people up for challenges, for failure, by saying, don't worry, rates are going to go down for sure. Use a temporary buy down. I did like 5 loans with temporary buy downs. I didn't promote it significantly. I'm not saying I'm smarter than anybody else. I'd like to think I am, but I'm not saying that. What I am saying is I like to focus on the here and now. I like to focus on this is the only thing that we know. And you have to plan for what is happening today. Now, there's obviously, and I did tell a lot of people, hey, don't buy down your interest rate permanently, because it's likely you're going to refinance before that permanent rate down pays off. But most of the time, my suggestion was not a temporary buy down. It was keep that money in the bank. Use that money to help you make the extra monthly payment. But guess what? Even those people have burned through that money. Now they're struggling to make ends meet. Now, if you put a bigger down payment when you bought a home, then you may want to think about, do I have other debts that are contributing to my affordability challenge? Can I consolidate my credit card debts and get a lower monthly payment? Maybe I can't lower my mortgage payment, but I can consolidate my credit card debts and get a lower monthly payment. Just be careful about debt elimination plans. Okay, these plans sound too good to be true. They say, hey, stop paying over there and instead pay us. We will make sure that we negotiate with them and pay them off, and we're gonna take great care of you and pay them off for 50 cents on the dollar, 25 cents on the dollar. Sounds really, really good. The truth is that they're ruining your credit in the meantime, because what they're doing is starving the current credit card companies by not paying them anything. And then within 6 months to a year, they're ready to charge you off as bad debt. That's when these companies who have been collecting money from you every month and holding it in their account and earning interest on it are then turning around and saying, hey, I got a little pot of gold over here. I know we owe you $5,000, but I could write you a check right now for $2,000. And that way you get something, because right now you're probably feeling like you're going to get nothing, Mr. Credit Card. And it's a great way to force a credit card company to settle and accept less money, but your credit gets destroyed in the meantime. So if you put a bigger down payment, think about a home equity loan or line of credit. Because although you're saying, I don't want to tie it to my property, or I don't have a lot of equity, there are situations that I can loan you up to 85 or 90% of the total value of your home. Now, the problem is you bought in the last year or two, home values haven't gone up a lot. So you may not be in a position to be able to do that, but it's something that we can look into. So really think about, what is my affordability? Where do I need to trim things? Maybe scale back on your 401k for a short period of time if you need to. I am very concerned about homeowners who purchased in the last couple of years that had the expectation that the market's going to get better, interest rates are going to be lower. They're no lower. Okay. I had a couple of clients who were talking to me in the last few months. They've got 4.5% and 5% interest rates, and they are struggling. That's a great interest rate compared to today. But when they bought, rates had previously been at 2.5 to 3, and they bought at 4.5 or 5. And so in their mind, rates were going to go back to 2.5 to 3. And so they expected rates to be that much lower, and it put them in a position where now they can't really do anything because they have a good rate, but that good rate is still more than what they can afford to spend. And that's the catch-22 that we're dealing with. Again, 2007, 2008, we had a huge market crash, a recession that was caused by the mortgage and real estate world, but that was a domino effect because everybody had adjustable rate mortgages. Nobody, very few, have adjustable rate mortgages right now. So you're not dealing with someone that has to refinance in order to keep their mortgage payment affordable. Back then, that was the issue. If I can't refinance, my payment's going to take off, and I can afford the payment I have today. I can't afford that higher payment when it takes off. So that was the issue we dealt with back then. The issue today, I think there are some people who are going to lose their home to foreclosure. I think there are some people who are going to be forced to sell and take whatever price they can get because they barely could afford the payment when they bought, and they were robbing Peter to pay Paul to get to the point to be able to refinance, and that point hasn't come. And so that's the biggest thing that I am talking about when I'm saying homeowners have been left out in the cold, is they're dealing with an expectation that rates are going to be a lot lower, a lot faster. The truth is, I don't know if we're ever going to get back to below 3% interest rates. The lowest rate we had pre-pandemic was between 3.25% and 4. And we were having those interest rates in 2017 through 2019. That was about the lowest that we were ever seeing. And that was in a period of super low inflation, where the Fed was trying to spur on the economy, trying to drive the housing market back up out of the challenges that they are dealing with. And so if you are a homeowner, I feel the struggle. The best thing I can tell you is look at other ways to trim back your expenses and look at debt consolidation, look at maybe pulling back a little bit on your 401k contributions or other contributions. All right, guys, that is it for what I have. I know I already have one question. If you have questions, post them into chat right now. If you're watching recorded, post them into chat for later. Real quick update, check out my podcast. Every single week I'm doing a new podcast. This week's podcast is about AI. I am a huge fan of AI, artificial intelligence. It is amazing how these systems are going to change our world. I'm talking to business owners, entrepreneurs in my podcast about how they should be thinking about AI. So if you're a business owner or an entrepreneur, or if you're just interested in that, check out my podcast. The link is down below. And I would be honored if you would subscribe and share it with anybody that you know. All right, let's dive into questions. All right, so Okie Dokie says, any Dream for All updates? So I have no new news. We continue to see a trickle of people getting Dream for All vouchers. We're in the exact same spot that I saw us in about a month and a half ago, which is more and more buyers who are getting the vouchers are either unwilling or unable to use them. And I think it's catching CalHFA off guard and by surprise. Now, we are about a month away from finding out if there's going to be Dream for All 2026. So what happens is the budget is passed. The budget is supposed to be passed by July 1st. So we're a month away from when the new budget is supposed to be in place. There's actually the draft of the budget may already be out. I need to take a look at that to see if the draft of the budget includes any money for Dream for All. My gut says no. The state is not in a surplus position unless something has changed, which I don't think it has. The state's not in a surplus position, and so they have to trim programs that are unnecessary. And this is one that, at least in the eyes of CalHFA, the state legislature, whether they provide Dream for All funds or not, isn't going to be a critical piece of the state's infrastructure. And so I'm not expecting them to release money for next year. I know a lot of you were talking about this year's money, but I just want to give you an update that if you don't make it off the waiting list this year, you'll want to be able to apply next year. Okay. So okie dokie 73. My number is in the 40s. I'm frustrated waiting so long. Why don't they just say if we should move on? I agree. Like, I completely agree. It's really what I thought I heard, I did hear from my contact at Calhaffa back in March saying, look, we're trying to wrap this thing up. We want to give out more vouchers than we know we're going to get fulfilled so that we can just tell everybody else, hey, go home. Stop waiting in line. No more tickets to the concert. You need to go home. And you're not getting that answer. Like, I totally understand your frustration. The fact that we've waited, it's literally been 11 months since the vouchers were starting to be issued. We're coming up on a year and they still haven't given us any idea. Slow trickle of numbers that are going down depending upon the region that you're in. I agree, and it's super, super frustrating, which is kind of the catch-22. Because a lot of people on the waiting list, even people who were ahead of you on the waiting list, probably have said, forget it, I'm done waiting, I'm going to do something else. And then they get their voucher, but they stop checking the portal, or they didn't pay attention to the email and they don't care, or they do pay attention and like, whatever, I don't need it, I'm not going to use it, but they didn't cancel their voucher. So when somebody gets a voucher and they're not going to use it, the fact is they have to go in and cancel it, or it's just going to sit there dormant for 90 days. And then it will get canceled if they don't extend. So that's the other challenge. People aren't proactively canceling their vouchers. And so that is the challenge that we're dealing with. All right. And yes, I think it's not a small purchase. I think here, I'm not defending Calhaffa. It's going to sound like I am. I'm neutral on this, but I'll tell you, how much more transparent can they be? Like, they can't predict how many people are going to use the vouchers. And you've got, like I just said, people who literally are getting vouchers and then just ignoring it and saying whatever and not paying any attention to it because they don't need the voucher. They're not thinking that they're harming somebody else. They are, but that's not top of their mind. Okay. So they're not canceling the voucher. Now, Calhaffa thinks they have enough that they aren't going to issue more vouchers, but at the same time, they don't want to send you all home because they're realizing a lot of these people later on the wait list, the further we go down, the fewer of them are actually buying. And so it's creating a major concern for them that says, look, it's like your doctor giving you a medical diagnosis. Like, I can't tell you for sure what it's going to be. And maybe that's a bad example. But the point is, they're guessing. They're taking a hypothesis, and they don't want to give anybody factual information because then later on you'll say, well, you told me X, Y, and Z, and that isn't true. And so that's their catch-22. Is there going to be another voucher expiration soon? Yeah, so basically, if you think about them all expiring every 90 days, we're looking at basically 12 months out. That's a little bit less than 12 months because 90 days times 4 is 360 days, 5 days short of 365. Forgive me for the stupid math. We're looking at around June 20th as being the next major expiration date. And in my view, it's a larger than average expiration date because that means that everybody who got their vouchers June 25th of last year, they had 90 days and another 90 days, which put them right around Christmas time. And then all of those people lost their vouchers at Christmas and new vouchers were issued right then. It's that cohort, it's that group of people that are looking to get their or have their expiration date on their vouchers coming up in late June. We also saw a lot of people get their vouchers the first and second week of October. There was kind of a big surge right there where we had a big group of people that got their vouchers. Some of those people didn't renew in December. So those group, if they extended for their 180 days are also expiring. So I do expect about a month from now, we're going to see a larger number of vouchers expiring. And so that is another opportunity. All right. If my file's with another lender. Okay, so I'm going to read this one out loud because I want everybody to hear it. If my file's with another lender, can I still contact you and run through the numbers to see if I'm still eligible? I don't want to run credit again. Yes, you can. I want to be super clear. I'm interviewing for the job to be your lender. If you want advice, I'm happy to give advice. If you say, John, I want advice, but I'm sticking with my other lender, look, I'm still going to give you the advice. I'll still spend time with you. The link down below, you can go to johnloanking.info or johnloanking.com, scan the QR code here, and you can get a link to schedule a call with me. I don't need to run your credit. But to be clear, I am looking to be your lender. So if you're concerned, I'm not going to do a hard pitch, hard sell, but that's what I'm here to do. And that's how I take care of my family. And that's how I'm paid. I don't have enough viewers yet to get paid off of YouTube. All right, guys, I think that's it for my questions. Okie dokie, I would love the opportunity. I agree with you 100%. I am the best. I'm just kidding. But hey, really appreciate everybody. Hope you have an absolutely wonderful weekend. We will talk with you guys soon. I don't know if I'll be broadcasting next Friday. I'll be traveling, and so we may be skipping a week. Let me see what I can do. But either way, I'll keep you updated. I really, really appreciate everybody. Please like, share, subscribe if you haven't already, and have an absolutely wonderful weekend. We'll talk to y'all soon. Bye-bye.